Hey everyone, it's Rick and Michael here with Heirloom Wealth Management. We are going to do a market update today. So I got some questions yesterday, and I'm sure some of you probably have questions, but we're hearing a little bit more about government shutdown. Elections are coming up. We've got some rate hike. The pesky Fed keeps hawkishly talking. So we have some things we can talk about today. Some questions that you guys have asked us. So I want to make sure we talk through some of that. So, I mean, Mike, I mean, what do we see as far as like? I guess we'll start with the government shutdown because that's every couple months kind of thing. I mean, it was like early summer, I think, last time we were talking about this, right? I mean, in general, when we see government shutdowns happening, what do we see reflected in the market in our portfolios?
Yeah, the government shutdowns tend to happen over time more frequently. It appears, at least that's the trend. And when that occurs, there are some hiccups in markets, some data that we normally would get from the government regarding labor statistics or things of that nature get delayed because there aren't people working to produce those data points. But by and large, I think that generally the investing public has become I don't want to say numb to this, but it's
It's an
just
old
kind of
story.
par for the course. It's part of what we've got to deal with. Typically retroactively, everyone gets paid. It's kind of a non-event in that sense. It's more of a bargaining chip to try to, it seems like right now, from what I understand, the debate is around changes to potentially immigration in order to approve the budget. It was approved yesterday. Now they're renegotiating. So it's just politics.
6 billion for Ukraine. I mean, yeah,
Yeah, yeah. And what impact it will have on the markets, I think might be considered negligible, at least from my standpoint. It doesn't influence the way that we would allocate assets or change what we're going to do as a result of if and when the
so the market volatility recently is probably less to do with government shutdown and probably more to do with like the Fed again.
Yeah, I think people are really grappling with not only the level of interest rates that we're experiencing in the economy, which today are at 20-year highs. In fact, you'd have to go back to 2001. I looked at this yesterday, and to find a effective federal funds rate that was as high as we have today. So we are in somewhat uncharted waters in the sense that today where interest rates are, most people, unless you're, north of 45 to 50 years old, you don't have much experience dealing with this. And so, that aspect of it is created some uncertainty. Markets don't like uncertainty. They like to know, what's going to happen. There was, based on, forward-looking estimates and expectations across the market that we'd reach peak rates, and then in 2024 we start to see rate cuts. The narrative that you hear from the Federal Reserve now is that we're going to be higher for longer. We're going to sustain higher rates. I certainly hope that we actually do have positive rates. I think that when rates were at zero for really the better part of a decade, that created a lot of distortions in markets, asset prices. Some of the difficulties people are dealing with today as far as, home affordability. If you're starting a career, and we just had lunch with a nice young woman today that, her goal is to buy a house. Housing affordability is gotten, out of reach for
7.5%.
someone even that's 25, 26, is doing well professionally, is difficult to be able to afford a home. That's a byproduct of very low rates, very low borrowing costs, that increased the value of those assets above maybe where they should have been. We need some sort of a discount mechanism in the markets to also subdue over speculation. When the cost of borrowing is zero, leverage increases, risk increases. And this comes in the form of what's described as endogenous risk, or risk within markets themselves. And so, last time we saw that manifest itself in a big way was in the banking crisis during 2008. Rates had been low. They started increasing them in 2005 to 2007. We actually saw a similar level of rates to what we have today. When rates increase, so to speak, when the tide goes out, you see you swimming naked. And so risks that had been taken in the marketplace that might not be fully appreciated begin to manifest themselves as a result of that increased costs of interest, payments, and also inability to access debt markets to support a business or an investment strategy. When that goes away, the math that worked at 0% rates might not work at all at 5 or 6%.
Which I don't want to derail us too far, but like, what's the like? We're gonna do a whole nother video on this, but like, what is the percentage of the S&P 1500 that can't afford its debt right now? That with the debt servicing levels and the interest rate,
Yeah,
it's astronomically high.
yeah. When you look at the percentage, and there's that's an interesting point. Like Goldman Sachs came out with a chart that looked at the trend of companies, percentage of publicly traded companies anyway, that are profitable versus not profitable. And today, roughly 60% of the publicly traded companies in the marketplace today are not profitable. And so that used to be north of 60% were profitable. So we've got a substantial increase in non-profitable companies. Zombie companies, if you will. The term, basically they're only able to survive by access to capital markets, be able to borrow money, issue stock, to continue operating their business. The market's willingness to give a long leash to a company that might be able to grow profits in the future but is not profitable now has gotten a lot shorter, and so that's definitely going to have an impact. Moreover, the number of total publicly traded companies is diminished over time as well. So you might want to take that in consideration. But today we're at a pretty interesting point in the markets, because if interest rates stay higher, whether you're talking about real estate values, stock values, bond values, everything that we look at from a standpoint of what is this worth. And we did another video on this, so I won't go too far in depth on this, but we have to look at those future cash flows that we expect from that investment and discount those back to what we think they're worth today. A higher risk-free rate, all else equal, means that those cash flows, those assets are worth less today than they might have been if rates were lower. And so the thinking that interest rates, might stay higher for longer is getting people a little bit edgy, maybe. So we're seeing some increased volatility in the marketplace. Rates have continued to rise across the yield curve. And so when we talk about the yield curve, what that means essentially is if we were to plot, from today to 30 years out, what rate of interest that we would expect to receive for making a loan to the government. This is the government yield curve. That is it's been inverted. First of all, that's important to note. A yield curve inversion means that short-term rates are paying more than long-term rates. Situations
doesn't
that
bode well for future.
well, that happens relatively rarely. So it's about 15 to 20% of the time that you have an inverted yield curve. Now, why would a lender be willing to, which as a bondholder, that's what you are, you're a lender, accept less money for lending money for a longer period of time? If you and I are talking and you say, hey, I'll pay you back in 1 week, okay, there's not a lot of risk that could happen, but you say, hey, I'll pay you back in 3 years. Well, things could happen over the next 3 years.
Or 30.
Yeah, right. The more time, the more interest. So why would a lender be willing to do that? Well, the reason why is because we expect for rates to be lower in the future. And typically, a yield curve inversion is a sign that, rough times might be ahead. And so, you might be able to get a higher rate of interest for, shorter term loans today. But if we have a difficult economic environment or a recession, those rates are going to go down. You'll have what's called reinvestment risk. You'll have to take those higher rates, that those bonds mature in the near term, and you'd be forced to reinvest those at potentially lower rates of interest. So people are saying, well, if I could lend for 5 to 10 years and lock in, 4.5% to 5%, maybe I'll do that versus taking 5.5% in treasury bills. And so
some of the questions we've gotten are like our bond portfolio now, and just hypothetically where we are on that timeline he's just talking about. Mike, I know we want to keep these kind of timeless, but a little bit pointed to what people want to hear about, like right now, is why we're pretty confident and bonds are like sexy for the first time in a long time, even though they haven't done much this year. And if you're looking at your portfolios, they're just kind of with bonds. But I mean, there's significant, I don't want to say, I would never say the word guarantee, but there's fairly predictable moves in bonds. unless you think we're at all-time highs forever, there's significant upside to be had in bonds right now
Yeah, I mean, bond prices are at decade lows. So,
because
you're
yields are at all-time highs.
they're at least over that time frame historically cheap. It doesn't mean yields can't go higher. Yields could certainly go higher. However, right now, the environment that we're in, there's a couple things to be aware of. We've seen inflation come down substantially. So inflation, today is roughly three and change. So this is the first time in at least 15 years that you can generate a positive real return, which is what am I getting from my bond investments, adjusting for inflation? Today, if inflation is in the 2 to 3% range over the long term, and you can make loans at for investment grade bonds north of 7% to collect from an interest standpoint, that's a positive real return. And when you look at that from a bond standpoint, there's a lot more certainty that we have versus comparing stock market investment with a bond. We're going to make a loan, we're going to collect a stated amount of interest, and over a predetermined amount of time, we're going to get our money back. Okay. So there's a 94% correlation historically to your starting yield as an investor to what your actual investments return. So that's a pretty high degree of certainty. So for making a loan or owning a bond investment today, for a treasury bond, you're getting anywhere from 4.5% for a 10-year bond. Treasury bills, which are shorter term, are paying 5.5%. Above what you're seeing for inflation in the marketplace. And inflation's a little bit of a slippery thing, because when we look at inflation right now, yes, there are parts of the market where we're seeing elevated inflation. Oil prices are approaching $100. I think they finished today at $96 and change. So there's parts of the market that are going up. Also, there's parts of the market that are coming down. Housing, for example. Housing, the way that they report housing in the inflation index, which it's a pretty big component of it between housing and rents, it's lagging by 12 months. Every 12 months, 1 month rolls off. So part of the housing inflation that we're looking at is back in 2022. And so that we can see that we're in a clear downtrend there. So we're at 3% and change. There's a tailwind for that to potentially move lower. But then there's, parts of the services sector. If you tried to hire anybody to do anything, it's pretty difficult, that are going to keep it relatively close to where it is now, in my opinion, to my best guess. So, but, from a standpoint of boring lending investments, bonds, you could still generate a very attractive rate of return, at least at this point in time, in our view. And where interest rates go are anybody's best guess. But there's a couple interesting things that I would put out there. One, when you hear the Federal Reserve talking about where interest rates are today, there's talk of maybe another interest rate increase before year end, and that being the expected peak for interest rates. And if we knew exactly where the peak for interest rates was, that's a pretty valuable thing. The reason being is that once you reach a peak federal funds rate, and we've got data, I was looking at this yesterday, that goes back to World War II, the average amount of time that you stay at that peak rate before rates are lowered is about 3 months. So it's a very small window. So while they might be talking about staying higher for longer, that would yeah, that would seriously buck the trend. In fact, the longest period that the Fed reached a peak rate and held it there ever was from July of 2006 to July of 2007.
12 months.
And that, so a 12-month time frame. So, take it with a grain of salt when you start to think about, okay, higher for longer. Yeah, that might be true. Moreover, we're in a situation where, yeah, we have an inverted yield curve, but that's started to de-invert. Historically, that has happened before recessions. Now, it's not a perfect indicator. Nothing, is. But, if we're at a point where we could be approaching a difficult economic environment, particularly if we start to see inflation remain subdued or economic growth declines. If inflation falls and economic growth declines, that's the sweet spot for bonds. Bonds, a promise, I'm going to give you cash today with some assuredness in the case of government treasury bonds, a federal guarantee that you're going to get paid back that amount of money in the future. If economic growth is declining and inflation is declining, that's highly desirable. That flight to quality, people start to get fearful. They buy bonds, prices go up, yields come down. From an investment standpoint, that could be a profitable circumstance. In fact, if you looked at, again, in another report, I sat down and talked with Goldman Sachs earlier this week. If you were to buy within 3 months of when interest rates peak, as far as the effective federal funds rate is concerned, your average rate of return over the subsequent 12 months is north of 11%. So for relatively riskless investment, that's high potential upside. If rates were to stay approximately where they are today or move a little bit higher, you're going to collect your coupon, 4.5%. But if they go lower, you've got the potential for a pretty attractive rate of return.
Upside.
So, bonds have, really, and the other thing, and I don't know a way to quantify this in particular, but just, the talking heads, the general vibe that you're getting from the investment community is that, hey, we're either going to have this soft landing scenario where we don't end up with a recession, bonds, interest rates, stay relatively level for a longer period of time. That certainly could happen. If that were to play out the way that the discussions are, the soft landing scenario, you can still get some pretty attractive rates of return from bonds, but I think that there's further upside there if rates were lowered due to a difficult economic
I want to
environment.
reiterate too, like a recession doesn't mean like everything goes down. To Mike's point, that might be a profitable move for bonds, but also, what the stock market is doing when we say recession, like those things are obviously, those can be different too. Stock market in general, holistically, is generally months ahead, 6 to 9 months usually ahead of like a true recession. So, Joe consumer is feeling a recession, stock market might be up.
Yeah.
So we're not saying run for the hills or anything either. So
I think the most important thing regarding that is that we don't know. Entering this year, nobody does. And anybody that's telling you any different, I would be extremely skeptical. Coming into this year, analysts collectively, this is the first time since 2001 that, we're predicted that we'd have a negative return in the stock market. Well, we're up double digits. We're in, entering October.
whoops.
And if you thought in January of 2020 we're going to have a pandemic, recession, we don't know what's going to happen to markets. And so in our view, the best way to invest is to diversify across assets that perform differently in different economic scenarios. The way that I tend to break it down, the framework that I think about it is you've got, picture a quadrant. On this vertical quadrant, you've got rising economic growth. On the bottom side, falling economic growth, rising inflation, falling inflation. We don't know what environment we're going to be in. Last year's a great example. We had a decade of very low inflation and, very stable economic growth. And then all of a sudden we've got high inflation and relatively modest economic growth. Bonds and stocks got crushed. If you didn't have something in your portfolio that could perform in that environment, you lost a lot of money. There's just, especially in real purchasing power terms, right? Because inflation was rising. If your portfolio of stocks is down 15 to 20%, you're feeling some real pain. Bonds are down more than 10%.
Yeah.
Conversely, like this year, we're in a scenario where, bonds are not performing very well. Stocks are performing very well. Real estate's, feeling some pain based on what's happened with the rise in interest rates. But, things are changing. Things are evolving. Rather than trying to predict and reallocate assets, to try to take advantage of that, which, we've seen how quickly things can change. If you can diversify across assets that perform, well in this environment, that environment, in such a way that you can reduce the risks that an unexpected outcome, economically speaking, torpedoes your portfolio by causing a large loss, you can really put yourself in a position to compound your money more consistently over time. Moreover, when big market dislocations happen, whether that be in the bond market like we're seeing today, stock market, wherever that is, you can have some dry powder to, deploy to buy things when they're cheap.
Yeah.
And so
We're right at 20 minutes. Anything, 15, 20 seconds you want to add about like today, right now, changes we might be making, maybe some tax loss harvesting stuff to...
Yeah, I think that that's always important this time of year where we have losses in the portfolio across positions, to sell those if we want to keep the exposures, find a way to do that via different securities without creating a wash sale. At this point, across all of our portfolios, we are going to be excluding dividend and interest income, able to throw off a capital loss unless something substantial changes between now and year end. That'll be the second year in a row that we could generate some tax losses for folks, which is always a benefit. Even though portfolios are up, we're able to harvest some losses this year to still keep things balanced.
Is it mainly in the bond bucket there that we're gonna take those?
Yeah. I mean, in stocks, we'll harvest losses if and when they occur. We have a rule that we'll sell something at a 5% loss. But the bond portion of the portfolio today, in fact, we actually harvested losses, repositioned, trying to maintain exposures, but through different securities to be able to realize those losses for tax purposes.
I'm gonna do a video on that, guys. But we're selling something and buying something very, very similar, and just taking advantage of the tax loss, but we're still participating in the underlying thing that we like. So that's called a wash sale and tax loss harvesting. It's pretty common. So we've done it for years for you guys. It's not, if you see it being sold, it doesn't mean we don't like it. It just means we're trying to give you a tax break and buy something very similar. So it's a way to really get. It's a good thing for you, even though the portfolios are up.
Yeah. Just to answer your question about like the way that our portfolios are positioned today, we are as defensively positioned as we ever have been, at least over our time period at Heirloom, which spans a decade now. The portfolios, both in equities, high quality balance sheets, strong, robust cash flows that are buttressed by ongoing secular growth trends. In bonds, low default risk, high quality. We have from an interest rate risk standpoint, as measured by duration, which gauges if interest rates move up or down, what the sensitivity to our portfolio is. We've taken advantage of the fact that rates have increased. We're actually taking more interest rate risk after being relatively defensive, lower interest rate risk up until entering this year. I think that's an important positioning. The portfolios, I think what I'm getting at are well positioned to whatever economic scenario unfolds to weather that. And, when dislocations, if and when they occur, we'll be able to take advantage of them.
Yeah. All right, guys, we're at the 22, 23 minute marks. We'll let you go. But if you have topics you want us to cover, let us know. Hit the subscribe button so you know when we have new updates, and we will talk to you soon. Hey, guys, if you like that, click here or here to see other videos that we've recorded, and we'll see you soon.